Hey everyone, welcome into another exciting, spellbinding, spectacular market takes. I appreciate you. I know you could have been anywhere in the world, but you're here with me right now, and I appreciate that. I am Dion, Rabouin, reporter for the Wall Street Journal, and today we are breaking down the latest existing home sales report, taking a look at the real estate market, the housing market, talking about what's going on in housing. We're going to talk about all kinds of things. First, we're going to talk about what that existing home sales report showed and how that compared to expectations. Then we're going to break down the current state of the U.S. housing market. Definitely going to want to watch that because there's a lot to talk about. We're going to talk about the relationship of the housing market and inflation and what could be on the horizon for both. We are also going to take a look at the market and then talk about what comes next because here on Market Takes, we are always looking forward, even though it is backward-looking data. So let's get into it right now. Let's talk about the existing home sales report and what we saw. Want to throw something up here on your screen so you can take a look at what I'm talking about as I'm talking about it. Now, the existing home sales rose 0.8% from the month before, but as you can see, existing home sales have just been on a decline. So what you saw at the beginning of 2023, really in March, April, you saw a pickup of home sales. This is the number of homes sold on an annualized basis. So in essence, what this month's home sales told us about the expected number of homes sold this year, you see that just coming down, and then this month you see it pick up. That little pickup could actually be a lot more meaningful than it seems. We'll talk about that in just a minute. Let's talk about the numbers really quickly. 3.82 million homes sold. That was much higher than expected. Economists had actually expected a decline this month for us to only sell 3.76 million homes in the U.S., a decline of 0.8%. So we reversed that. And last month, where there was a decline of about 4% sold. That was the lowest level since 2013. So that line you see there, where we got down to, that was the lowest number of homes sold, the lowest level of homes sold since 2013. So that is a big time decline in terms of, the lowest number sold in 13 years. So going back actually to 2010, excuse me. So what we're seeing this month is a bucking of the trend, a reversal of the trend that we had seen coming in. Again, you're seeing up there just a little pickup, but that could be meaningful. And this chart just illustrating the overall trend that we've seen, which is home sales going lower, and then this month, a little bit of pickup. But again, that could be meaningful. We're going to talk about that in just a minute. Prices were lower than they were in October, declining to $387,600. The average or the median existing home sold for $387,600. That was down from $392,000, or a little bit under $392,000 in October. But prices are up 4% from where they were a year ago, and it was the fifth straight month of year-on-year price increases. That is significant. We're going to talk about that in just a moment. We also saw in this month's report the inventory of unsold existing homes declined, fell about 2% from the previous month. So there is now the equivalent of 3.5 months of supply on the market based on the current monthly sales pace. That is significant. We'll get into all that in just a minute. Want to read you a quote here from National Association of Realtors Chief Economist Lawrence Yun. The National Association of Realtors, they put out this report. Lawrence says, quote, "Home prices keep marching higher. Only a dramatic rise in supply will dampen price appreciation." Basically what he's saying is, as that supply has come down, demand has stayed where it has been, and folks still want to buy houses. Unless we see supply increase, because as we know from our economics textbooks, and if you watch Market Takes, I say this all the time, supply and demand. It's all about supply and demand. Right now, we've got strong demand. Lots of people want to buy houses, but there is low supply. And what happens when you got high demand, low supply? You see prices keep rising. And that's what Lawrence Yun is talking about there. So let's talk about the other big variable when it comes to the housing market, and that is mortgage rates, right? Let's take a look. I want to throw a chart up here on your screen right now. Shows us the mortgage rate. And I usually only throw the 30-year fixed rate up there, but I put the 15-year up there for a specific reason. You see the same trend in that 15-year rate that you're seeing in the overall sales rate. So while the 30-year mortgage rate has just continued to fall along with that 10-year yield on bond prices, we did see an unexpected pickup on the 15-year fixed rate mortgage. That has come, we have seen about the fastest decline in bond yields since 1987, since Black Monday in 1987. The 10-year rose and fell at the fastest pace since Black Monday in 1987. So what you see, the 30-year fixed rate mortgage aligns with that 10-year rate. Usually the 15-year does as well, but again, last week we saw a pickup, an unexpected pickup in that 15-year mortgage rate. Now, the other thing you have to keep in mind with what this chart shows on your screen is that rates fall in line with the market, but the market is ahead of these rates. So what we saw is the report from November when those rates were about at their peak and then started coming down. What that shows us is that even though rates just went down a little bit, we're now down below 7%. Rates got under 7%, but that wasn't until this month in December. The report we're looking at is for November, where as you see the rates were still high. That's about the peak there at the end of October and then moving into November. So rates peaked in October, started falling in November, and you still saw again the unexpected increase in sales. You saw that pickup in sales. So even though rates had come down just a little bit from that peak, just below 8% that we had seen, rates still in the high 7s, mid 7s. Now they're back down, getting below 7, but that didn't happen until this month, December. So we could start to see another pickup because even with rates high at that level you're seeing on your screen, folks were still going out and buying. And this chart just illustrating again that as rates decline, any kind of decline you see in rates, you're seeing a big pickup or a notable pickup in sales, and that's significant. And when we got now where we are in December, the last report from Freddie Mac came out December 14th. We'll get another report tomorrow from Freddie Mac on where mortgage rates stood, but you can expect those to come down because we have seen a significant decline in bond yields. We're going to talk about that when we look at the markets, but as we've seen that decline in bond yields, we've seen this decline in mortgage rates, and we did see a pickup unexpectedly of home sales last month. Want to talk again really quickly about Lawrence Yun. He had another quote that I think really sums up this report and tells us what to look for next. I think is big if Lawrence is right. Lawrence Yun, Chief Economist, National Association of Realtors, says, quote, "A marked turn can be expected as mortgage rates have plunged in recent weeks." So on Market Takes, what do? We talk about the markets, and the markets affect the real economy, things like mortgage rates. As bond yields have just come falling down, crashing down, mortgage rates trail that. So we are expecting to see, if you're looking at the market, you can expect that mortgage rates are going to come down. So as mortgage rates continue to come down, what we have seen, the theme and the trend has been mortgage rates go down, home sales go up. Even though people are still paying almost double in terms of their monthly payment, what they would have paid 2 or 3 years ago, they're still rushing in because people still want to buy homes. Again, high demand, low supply. So those mortgage rates have really put a bit of a crimp on demand, but not that much. And as rates come back down, now we're below 7%. If you follow the market, you can expect to see that rates will continue to come down on the mortgage side, further below 7%, maybe getting down to around that 6.5% level. That could really put a floor and push higher up the number of sales, push that housing market back into, again, what Lawrence Yun is saying, a marked turn can be expected in the market. So keep your eye on that. The mortgage rate on 30-year fixed was about 6.95%. That was the first time since August 10th we had seen rates that low. So keep that in mind. Let's talk about another way the market is looking at the housing market. I want to put a chart up here on your screen right now, and that is of the S&P Home Builders ETF. Now, this is basically an ETF, an exchange traded fund. This is a stock, or it's an asset vehicle that moves like a stock. It looks at all the big housing companies, whether that's Toll Brothers, whether that's KB Home, all of them. It looks at them and it says, okay, what are their stock prices doing? Well, since the end of October, those stock prices have basically been looking hockey stick-like, moving straight up. You saw a little bit of a reprieve earlier this month, but that's over now. This index moving way higher, and folks are still excited about those homes. Folks are still excited about what's going on in the housing space on the market side, and that could be pushing higher. And again, this really aligns with the big decline we've seen in the 10-year yield, the decline we've seen in mortgage rates. We've seen the price for this Home Builders ETF spark higher and move higher in a very significant way, as you see right there on your screen. And that just illustrating, again, the overall market bullishness that folks are expecting when they see rates come down. They see sales go up, they see the mortgage rate come down, and that's what the market is taking back. And this all comes back to what Lawrence Yun says, a marked turn can be expected for the housing market. We have seen a decline in sales, which has kind of pulled down prices. you could be expecting, as we saw. So when I talked about that little pickup that we saw in sales last month, you could start to see that market reverse course and start to move higher, even though we are still seeing very high mortgage rates. What does that relate to for folks who aren't looking at buying a house or aren't thinking about rent? Because again, as housing prices rise, you should watch out, because that has a direct impact on what you pay for rent. If you're looking to rent a house, if you're looking to rent a condo, things like that, stuff that folks own, well, when they have to pay more to buy it, they have to charge you more to rent it out. So this really relates to everyone that's looking at buying a home, that's looking at renting, all those things. You could be expecting prices to go up. The other thing this has a big impact on is inflation, and could have a big impact on inflation. Housing prices are expected this year to put downward pressure on inflation going forward. As in, the expectation is over the last few months, we have seen housing push inflation higher. It's been one of the big things holding inflation above that 3% level. The Federal Reserve wants to get inflation down to 2%. Right now, it's at about 3%. The market is cheering, it's moving higher, it's saying, all right, the Fed's gonna be able to cut rates. Fed is looking, they're saying, hey, we think we might be able to cut rates next year. I talked to Fed President Austin Goolsbee. The WSJ Take on the Week podcast is out now. Get that wherever you listen to podcasts. Austin Goolsbee's on that, talking about it today. That's really the Fed's bias right now, is to start cutting rates. And you can hear that when I talk to Chicago Fed President Austin Goolsbee on WSJ's Take on the Week. Download that wherever you get your podcasts. But that comes back to this housing report, because if housing continues to put upward pressure on inflation and not downward pressure on inflation, housing is about 40% of the overall CPI inflation index. So if housing prices are rising, if then those people are buying homes and then landlords are raising the price on rent, well, that's going to push inflation higher, or at least hold inflation high at around this 3% level. The Fed has been very clear. They don't want inflation at 3%. They don't want it at 2.5%. They want inflation at 2%. And so if we do see, as Lawrence Yun, chief economist of the National Association of Realtors, is predicting, higher rates, that we could see a marked turn in the overall market for home sales, that could push prices back higher, because again, still low supply. And if you get that increase in demand, well, now you've got even higher demand than what we're looking at right now. And that could have a major impact on the housing market and could play a role in the overall inflation market. Now, we know that housing is a lagged indicator, as in it comes into the inflation data slowly. But if folks are looking at the owner equivalent rent, as in what someone who owns a place pays for rent, which is their mortgage payment, we know taxes have been rising, right? Property taxes have been rising higher. We know that insurance costs have been rising. Well, if home prices start rising again in a significant way, that could put some real pressure on that owner equivalent rent, on that overall housing and shelter index. That's a big part of CPI, and that could hold inflation higher. So that's definitely something to keep your eyes on. The rally so far in 2023, this big stock market rally we're going to talk about in just a second, that has been driven by expectations for inflation to fall quickly to 2%. So this report that we're seeing today, really, if you're a savvy investor, you're going to want to factor that into your thesis and say, okay, maybe this inflation theory isn't really going to come true. Maybe we're not going to get inflation down to 2% as quickly as maybe the market is expecting. And maybe that means the Fed's not able to cut rates as quickly as the market is expecting. Market factoring in a rate cut as soon as the Fed's second meeting this year, and 6 rate cuts for 2024. That is significant, and if that doesn't happen, if those start to get priced out, that could have big impacts for the stock market. Well, let's throw one more chart up here on your screen so you can take a look at what I'm talking about when I talk about housing prices. So let's put that up right now. As you see, this is the U.S. House Price Index. It's only going in one direction, and that is up. Right? We saw a little bit of a decline in 2022 when those interest rates started rising, or when those bond yields started rising. But really since then, even as you saw home sales go down, you're seeing a big pickup in the price of housing. And you see it's just going straight up. That contrasts with what we've seen from housing sales. Now let's throw the other chart up here on your screen again. Existing home sales moved in exactly the opposite direction over the past few years, right? Just down. Well, if those sales start to move up, what do you think that's going to do to prices? It's going to push them even higher, put even more of a floor or a higher bias on those housing prices. And again, these charts just illustrating what we have seen, right? Which is that even as prices, or even as the number of sales has come down, we have not seen a decline in prices. In fact, we've seen prices continue to move higher. All right, so big picture. What's the market thinking? Market's not thinking about any of this. Let's throw up here on your screen. Let's take a look at the markets right now and what we're seeing from the Dow, the S&P, the NASDAQ, all higher on the day. Investors very bullish on the market right now. The Santa Claus rally is in full effect. Santa's been coming down the chimney for about a month and a half right now, and investors are really loving it. What it really comes down to, though, it's all about bonds. And we have seen significant declines in bond yields, those prices going back up. We're seeing right now a little bit of a decline, but let's point to what we've seen year to date, right? And that's a significant downturn. If you look over the past 3 months here, what we've seen is basically just bond yields plummet. This is the 10-year, the most actively traded bond contract, and we are just moving down. We are now below 4%, and actually earlier today, we were below 3.9%. This is the lowest bond yields have been in a long time. This is even more significant if you look at the 2-year Treasury note, which is most correlated with expectations for what the Federal Reserve were going to do. Folks are really betting hard the Fed is going to start cutting rates in 2024. And again, this housing data plays a big role in that. Also, you want to check out what's going on with the dollar. We see the euro going up higher, which means, the euro going lower, which means the dollar is going higher. We check out the US dollar index, was moving a lot higher earlier this morning, came back down, but as you see in the last few minutes, maybe the past 20 minutes, you've seen a big spark up higher in the dollar. That's the US dollar index, which measures the dollar against 6 peers. You got the WSJ dollar index, which measures the dollar against 17 peers. So a more well-rounded index, that's that WSJ dollar index. But the dollar moving higher, that could again put some pressure downward on inflation, but we are seeing a move. Usually when yields go down, the dollar goes down, but folks in the currency market having some different thoughts than folks in the bond market. That's definitely something interesting. Last thing I want to point out to you on the markets is what's going on in copper. And right now we got copper holding on a little bit higher, but when you look at the year-to-date movement on copper, we see that there is a bit of a trend moving higher. That's usually aligning with expectations for the overall economy. Folks expecting those copper prices to go higher, expecting GDP to pick up, and that's the big picture there. Really what we're seeing in markets just kind of illustrating overall bullishness from investors that continues. So what comes next? Well, we get the third and final estimate of US GDP from the third quarter that is out tomorrow. If that comes in higher than expected, again, that could really put some more bullish momentum higher in stocks. If it comes in weaker and weaker than that first estimate that we saw that was 4.9%, investors might be thinking twice. But that's going to be something you'll want to watch. And then the PCE inflation report is out on Friday. That is the Fed's favored measure of inflation. That'll be out along with the personal income and outlays report. I've been watching that closely because it shows real wages, real disposable earnings, what Americans are really making on their paychecks, and you want to watch out for those reports. Last thing, I talked about it a little earlier, but my podcast, y'all, WSJ's Take on the Week, hosted by me, yours truly, Dion Rabouin. For more, check it out. We cut through the noise to explain the major business and financial news that moves the markets, all so you can make smarter investing decisions. Subscribe wherever you get your podcast. And like I said, we got that interview out today with Chicago Fed President Austin Goolsbee. You won't want to miss that. And we have a brand new episode coming out this Sunday. Be sure and check that out wherever you get your podcasts. And listen, that's going to do it for us here on Market Takes. I am Dion Rabouin, reporter at the Wall Street Journal. Thanks so much for being with us. Hope you'll come back and do it with us again next time.